told you it was a ball confusion day. I mean, you got to ask, what the heck happened to the stock of United Rentals? Here's a high-quality equipment rental company that I've been recommending for ages. Just this week, I told you it was a much better buy than Caterpillar. And what happens? Well, last night, United Rentals reports what I thought was a real good quarter. Company delivered a monster 41-cent earnings beat off a 246 basis, higher than expected revenues up nearly 28%. Holy cow, those are strong numbers. They even announced a $1.25 billion buyback, and they got a debt upgrade today. Yet the stock got slammed and tumbled $11.78 or 6.5%. Why? Well, maybe because management decided not to raise its full-year guidance despite the huge beat. Maybe this made investors nervous that the rest of the year might not be as good as the first quarter, even though they didn't actually say anything about a slowdown. So did the market make a mistake? Are you getting a rare opportunity to buy a stock that has almost tripled in the last 2 years? Or maybe there's some reason to be concerned. Let's check in with Mike Nealon, the CEO of United Rentals, sort out what actually happened with this quarter. Mr. Nealon, welcome back to Mad Money. Good to see you, Mike. Have a seat.
Good seeing you, Jim. Thank you.
All right, so Mike, in a vacuum, I'm reading through the conference call, and I'm saying, you know what? These guys, same-store sales up big, volume up big, non-residential great, industrial great, oil and gas. And then I look at the stock, and I say, well, okay, stock's wrong or I'm wrong. I'm betting that I'm not wrong. Tell me your depiction of what you think happened with this quarter.
Well, I think what happened this quarter was I was very pleased with it. Number one, we achieved three critical things I think is very fundamental to our industry. Number one, we saw rates improve. We saw used pricing improve. And on top of that, we saw time. Time was down a little tick.
Right, that freaked people out, but there are a lot of reasons why that could be.
But that's the second highest level we've ever had in this first quarter. So I don't know how the overreaction or the reaction on the marketplace. I can only tell you that what we see in the market is a really solid 2018, the whole year looks very solid for us.
Well, then should you have raised guidance?
Well, we don't. We don't raise guidance in the first quarter. Okay. You know there's a seasonal aspect to our business.
Right.
First quarter being the lowest. The next 45 days into the second quarter is going to be the most critical for us. Right. And as we think about that, we'll make the adjustments if we see it. But I can tell you what we see, it gives us a lot of confidence on our guidance that we've given for the full year. And
that's a real buyback. You didn't announce a buyback to be able to say if it gets to 130, we're going to be a buyer, something like that.
No, we've already achieved several buybacks, and we've already done $2.3 billion worth of buybacks. It's really our capital allocation and the excess cash flow that we have.
Okay, now then I start thinking, okay, well, maybe someone's worried that the tariffs are raising the price of steel, which then makes it so that you have to pay too much for your equipment, but you get it back on the back end. If you sell it, you got good rates. So I thought that was a nonsensical reason that I heard today about why your stock got hit.
You know, we haven't seen it. To your point, we have great relationships with our vendors. We negotiate well in advance, and we secure our purchases for the full year. So it's not going to affect us.
Okay, now I like something that I wanted to point out that these analysts don't. You have a competitive positioning slide, and it says investments in technology. All the companies I follow that are doing much better than everybody else, they invest in technology, they have big data. What are you doing in technology that's making so you're making so much money?
So for us, we started out with telematics. We had to put telematics on our total fleet. That came at a cost, not only a cost to install it, but it's actually a cost on an annual basis.
And it does what for our viewers now?
It does a lot of different things. One, it eliminates any kind of waste trying to locate a piece of equipment. It identifies whether it's low on fuel, whether it needs service. So it helps us, but it also helps our customers, more importantly.
Okay, now you have a consensus forecast for U.S. construction put in place, but I see some of these numbers. I think you're doing much better than a lot of these markets. Oil and gas, it's been super for you, right?
It's been super, but I can tell you right now, what used to be about 11% of our business is only about less than 6% of our business. Still growing,
right?
But it shows the fundamentals that the economy is still solid.
But non-residential, terrific, right?
Non-residential is doing exceptionally well.
You know, okay, so look, you've answered my questions. I think that a lot of times what happened, Mike, it's been a great stock. And there are people who always think, like I heard all day today, it's got to be over. It's been too good. It doesn't, right?
No, it doesn't. I mean, if you look at all the leading indicators, all of them, they're either at record highs or damn close to it.
Right.
And I will tell you that everything I see is going to point to a solid year. And don't have to listen to me. Listen to my competitors. They're saying the same thing.
Well, I mean, it does come down to, in the end, it's empirical. That same-store sales figure, you just have to explain to people how much better it is than what you thought than last year at this time.
Oh, I mean, again, getting rates in Q1, which is our weakest time in the season, is, to me, a telltale sign.
Right. Well, look, I'm so glad you came on because, yeah, you spend that when I announced, that, for instance, that you're on tonight, and I'm seeing people posting, well, this is it, he got it wrong, this and that. No, stocks can be wrong. It's been wrong a long time. We've seen that, and what it's done, it's tripled. That's Mike Dillon, CEO of United Rentals. I'm sticking by it, okay? I am sticking by what I said about CAT and URI. Mike, thank you so much.
Thank you, Jim.
Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.